Welcome to a phenomenal edition of Rebellion's educational series. I'm here with one of the smartest quant minds on Wall Street, Nancy Davis. It's amazing the respect Nancy has around the street and her wisdom. We are excited to have with us today. Thank you so much, Nancy.
Thanks for having me.
Pleasure's all ours. So, first question is on interest rates. What is your view over the next 3 to 6 months?
Well, we have the expectations are that the Fed is going to continue hiking rates. Right now, just to put a stamp in it, it's right before Thanksgiving in November. We have 55 basis points of additional hikes priced in before the end of 22. So that's a month and a week. So that's fully priced in. The surprise would be if the Fed hikes 75 at the next meeting. And then the following year, we have another 25 basis points of hikes priced in. So I think really the question is will the Fed meet those expectations or exceed those expectations? Because we have additional hikes priced in. And you can see that with the level, the 2-year swap rate right now is 4.81.
And so, do you think they'll raise the rates more than 50 basis points at the next meeting?
No, I think they'll raise 50 at the next meeting. So there's a little bit extra priced in because we have 55 priced in before the end of the year. I'm just looking at Fed Fund futures to get those estimates. I think it's a really easy way for people to look at the basis points rather than looking at the probabilities of hikes. I know a lot of the websites out there that are free to the public look at the probabilities. It's obviously the same math, but I think just looking at basis points is a very simple way to do that.
Yeah. Fantastic. So, how do you feel about housing in the US over the next 3 to 6 months?
Well, definitely, on our fact sheet for our fund, I've always said that, real estate investors, they hedge their rate risks, but regular people don't. And that was part of the reason that we wanted to create this product that accessed the interest rate markets, because I do think it's something that, the reality is most people around the world have the bulk of their net worth tied up in real estate. And I think it's very important, especially given inflation is at, 40-year highs and the Fed is not in the QE environment anymore. We are hiking policy rates. I think it's super important for everybody to be focused on their embedded interest rate risk.
So, looking at drivers of inflation, you'd say then that housing is going to come down some and will probably help bring a lower inflation number.
To me, it's not really taking a bet about whether housing is going to come down or not. Most people have it inside their portfolio. Even if you're don't own a home and you're renting, say you're renting an apartment, you're at risk that inflation increases because then your rents will increase. And so I think it's one of those things that I think a lot of people right now are betting like a trade, whether inflation is going to be increasing or decreasing, or whether we've hit peak inflation. To me, I think just part of a balanced portfolio is having some exposure to interest rates and exposure to inflation expectations in the future. Because why not? We live in a real world. And if you don't have it inside your portfolio, you're actually short it in your real life. And that's one of our focuses from the education point of view, is that a lot of the passive indices like the ag index, it used to be the Lehman ag and then it was Barclays ag and now it's called the Bloomberg ag, but it's a really old index and there's no inflation protected bonds in it, and it's only short volatility because of about a third of it is US residential mortgages. And so it's just, I think, super important that investors are aware of, even if they have an active manager, most of them are benchmarked to the same index, so they just don't have inflation protection inside those portfolios because it creates tracking risk. And then they're only short interest rate volatility because US homeowners are along the option to prepay. So, if you think about it, if you own a financial mortgage, you're essentially short options to homeowners. They call that prepayment risk or the negative convexity. It has lots of I call it G-rated words for being short volatility. And it's not equity vol, it's actually fixed income vol.
Well, speaking of volatility, if the Fed only raises rates 50 basis points, there could be some significant potential for the equity markets to run before New Year's. Is that something you could see?
I mean, consensus has definitely been very, very bearish. I went on I happened to be on CNBC over, it was actually like literally the bottom of the market this year, and I was like, I think we're due for a rally just because everybody was so consensus bearish. I feel like now the equity market has rallied a bit more, and so it's not as obvious about what's going to happen as we go into year end. And I think the challenge is that a lot of companies are experiencing is with the labor market. The labor market is way too tight. A lot of people have left the labor market and they're not necessarily looking for work right now. So it doesn't show up in the employment numbers, but there's really a scarcity of people for certain jobs, whereas other sectors like tech right now are laying off. So I think the issue for all corporates, whether it's equities or corporate credit, is that kind of stagflationary outcome where we have, higher prices, potentially higher input prices or more supply side disruptions coupled with higher labor. And will consumers still be there to step up on the demand side with the Fed being so hawkish and hiking policy rates?
Well, speaking about the supply side, do you have a view on China not reopening? Now the new COVID controls. I'd love any thoughts you have.
Well, it seems like a bit of a free option because the market is definitely not expecting them to reopen. And so I think that could be, look, there are a couple of positive shocks that could happen as well. We could have resolution, hopefully, with the Russia-Ukraine situation. We could have China reopen. There's a lot of negativity built into market expectations. So I think investors really have to be wary about all the tail risks, whether they're inflation tail risks or risk on tail risks or risk off, and just having a really diversified portfolio to not be trying to have a crystal ball about what's going to happen in the future. I think that's really something people often fixate on with macro pundits and trying to bet about this is happening or this is going to happen. I think that's really where portfolio diversification comes into play, where you can be a long-term investor, but just not have everything, correlated with each other. If everything in your portfolio is going up or down together, you're probably not very diversified.
Reminds me of my friend Perry Boyle, who worked with Stevie at Point 72, and he said that they do 3 investor meetings in a day. In one meeting, he'd say it was going up. Next meeting, he'd say the market's going down. And the third meeting, he'd say the market's going up. Just depend on how he's feeling. Nobody really has that crystal ball. Nobody knows the market's going.
Yeah.
So what's your take on terminal rates?
I think there's a lot of focus on that. I think the thing I'd like to remind investors is the Fed only controls the policy rate, which is an OIS rate. It's an overnight rate. That's what, Fed policy, all central bank policy is the overnight rate. The market is really the determinant of the term structure of interest
Just
rate.
to pause for our viewers who aren't a financial background, the overnight rate refers to the cost for banks to borrow from the Federal Reserve.
Yeah, so when the Fed hikes rates, they're hiking their policy rate. So that's the spot rate, which is overnight. There are a lot of different interest rates in the world, even in the US dollar market. There's a treasury rate, which is the treasury bonds. There's a swaps market, which is actually way larger than the treasury market. That's where, we've heard a lot about it from the UK, but there's swaps are much larger than treasuries, and the swaps market is also not where the Fed conducts their QE purchases. And I'd say the thing that's really fascinating about what's going on right now is the swaps market is the most inverted in the history of the financial derivatives going back to the 80s. So currently, the US dollar swap curve, if you look at the difference between the 2-year interest rate and the 10-year interest rate, is negative 107 basis points. So what that means is you get paid 107 basis points more to have, loan the US 2-year paper versus 10-year paper. Or said another way, you actually get a negative yield to own longer duration bonds, which doesn't make, it's really a perplexing thing, like, because you're taking more risk with duration to own a longer dated bond and you're getting paid less for that. So it's never been this inverted ever in the history of the swaps market, and it's never been this negative and this long. So the market is really pricing in that the Fed is going to have a, cause a recession, pivot, eventually cut rates. And that's why investors are saying, look, we'll take less yield to loan the US government money for longer. So it's really a weird environment right now.
This was a fantastic conversation, Nancy. I'm so thankful
Okay.
you came on. And for our investors who would love to give you their money, where can they learn about you and your fund?
Well, I'm not a financial advisor, so we don't accept, client money directly. We run fixed income ETFs, so we have our funds, and they can ask their financial advisor if it's appropriate for them. But we run an ETF as an exchange traded fund, and I manage two of them as a portfolio manager. So
And that's the quadratic volatility.
yeah, it's a mouthful. It's called the first one that we listed is IVOL, not eyeball, but IVOL, like interest rate or inflation volatility. The whole name of the fund is the Quadratic Interest Rate Volatility and Inflation Hedge. It's a bit of a mouthful. And then we also had a demand for investors who really think that their portfolios that are at risk for deflation. So we also created the Quadratic Deflation Fund, and that ticker is BNDD. They're both listed on the New York Stock Exchange.
Awesome. Well, this was really fantastic episode, and I'm so thankful. I look forward to you in the future, Nancy.
Thank you so much. Sorry about my cell phone going off.
Don't be silly. Be well and happy Thanksgiving.
Thank you. Happy Thanksgiving.